I host VCTV every day, Monday to Friday, 8 p.m. Singapore. So the whole idea behind VCTV is the platform to provide the entrepreneurs to connect with investors. Yes, you heard it right. The founders and entrepreneurs get an opportunity to meet investors and make connections and network and get funded. So that's the key selling point about VCTV. So startups and founders who are watching us today, we have a very interesting topic today coming from all the experts on the panel today. Startup education, and how to become the next unicorn, so as to say. So entrepreneurs, founders, and startups, do tune in and let's hear from the experts how they're going to, as they're going to say, how the steps needed to be an unicorn. Today I have Shrikant from India, Harsh from India, Gary from Florida, and Sergey from Moscow. Welcome to VCTV, all of you. How are you today?
Fantastic.
Awesome. That's what we like to hear. Fantastic. Great. I'm going to start with Harsh today. Harsh, please start with your introduction, some background. I just forgot one thing to mention. I have a co-moderator today. Surprise, surprise. I've got a co-moderator. His name is Amit Das. Amit, please introduce yourself.
Oh, thank you, Sony, for that short introduction. My name is Amit Das, and I work here at LATOKEN with Sony, and I'll be co-moderating the show along with Sony Mohanty, and I have some exciting questions and a lot of learnings from this session today. Let's hope for the best. Over to you, Sony.
Yeah, thank you, Amit. Thanks for that quick intro. That was lovely, awesome. Harsh, over to you now, please. Thank you.
Thanks, Sony. So I am Harsh Shethia. I'm currently a venture partner with our ventures, and we've done a lot of investments in a lot of upcoming potential startups, and I've had good exits as well. I've had the opportunity of working for one of India's leading unicorns called Paytm. So I believe I'll be able to add a lot of good value to this session, understanding how Paytm used to work inside out, and I also used to be a growth hacker in the past. So I'll be able to add some insights over there as well. Thank you.
Oh, yeah, we'd love to know all the success stories. Thank you, Harsh, and welcome to VCTV. Next, I have Shrikant. Hi, Shrikant. Welcome back on VCTV. Some background intro, please, from you. Thank you.
Pleasure is always to be here, and I'm a M&A advisor. I'm a family office advisor. I'm based out of India, Bangalore, and you could reach out to me at LinkedIn.
Fantastic, and welcome back. Next, I have Sergey. Sergey, are you there? Okay. I think he's going to be online soon. Gary, over to you, please. Thank you so much, Gary.
Yeah. So my name's Gary Fowler. I'm a serial entrepreneur. I've actually started the first accelerator in Russia at Skolkovo Startup Academy. I'm the co-founder of that, and also the largest private corporate accelerator. So Guy Kawasaki and Steve Blank and Bob Dorff, the whole leading startup folks, Osterwalder and Design Thinking. So we spent a lot of time refining the model. I'm the CEO, president, co-founder of GSD, Get Shit Done Venture Studio, premier AI venture studios for growth stage companies that are looking to go global. I write a lot about entrepreneurship. I just wrote another article actually, so 109 or 10 or 11, I don't know, something like that last year. Articles about entrepreneurship and artificial intelligence and quantum. So we're deeply into the system and understand that there's an incredible opportunity.
Yeah. Welcome back, Gary, and we're going to know all this expertise coming out of you to how to be the next unicorn for a startup who's looking to follow that step. Before I open up the panel for questions, I just want to start with a little bit of background. What is a unicorn? What does a unicorn mean on a VC world? So in a VC world, a unicorn is a privately held startup company that is valued over $1 billion. It's a term that's become very common, but where did it come from and why these companies are called unicorns? So today we're going to discuss this topic in details. Who is a unicorn? What are the steps need to be taken by a startup to become a unicorn? What are the challenges? Can every startup be a unicorn, actually? And is it really important for every startup to work towards becoming a unicorn? So these are some of the topics we're going to discuss today. So sit back, tight, as we start our panel today. I'm going to start with Shrikant. Shrikant, over to you. So let's start with founders, because founders are the people who make up a startup. I mean, they are very important and integral part of any startup. So let's hear it from you. What are the importance of founders in a unicorn? So how should they be doing? What should they be doing? What are the attributes? Over to you.
Well, I think confidence is one of the most underappreciated or overappreciated things. I mean, it's a very bipolar thing that happens in a unicorn. Either the founders think they are a $1 billion company right from the time that they even incorporate, or they think they are worth nothing even before they incorporate. So I think uh, uh, a check on reality has to happen for founders to see whether they are in touch with the reality as such. And maybe Harsh would add to my perspective over here, and I'm here to listen to Gary as well.
Yeah.
I think the fundamental attribute which founders lack is confidence, and the same time also seem to be having too much is also confidence. So either way, it can backfire.
Okay. So it's about overconfidence and low confidence. So you have to have a balance. Thank you so much, Shrikant. Harsh, over to you.
Yeah,
Yeah, please, your
got it.
insights about this. What's the importance of founders in a startup towards becoming a unicorn? And do they need to have any deep expertise in a specific industry to be successful? So over to you, please.
Got it. So I personally am of the opinion that, obviously confidence is an important aspect, right? But additionally, when I look at a founder, when I'm kind of, validating a startup, I'm looking for that something special, that something extra, which the founder brings to the table, that unique edge, that unique special quality, which only the founder can add, to the startup. Without which it becomes a very difficult, becomes a regular business, right? What differentiates a startup from a regular business is that they are doing it something unique and they are disrupting something that can only come with your years of experience within the industry. When the founder has 5 years, 10 years of experience and is identified a huge gap, and that gap is potentially worth tens of billions of dollars. And if he can capture around 10 to 20% of the market, it becomes a unicorn. So that is one of the major criteria which I look at when I'm evaluating a potential unicorn.
Right. Thank you so much, Harsh. Gary, you have built many unicorns.
I haven't built many, but I built a couple. So,
So let's just hear from you.
well, let's go back to basics. I mean, what are some of the basic fundamentals? Number one is a team. Do you have the right kind of team to be successful? So do you have marketing? Do you have somebody that's technically astute, and do you have somebody that can do operations? Or the CEO and another co-founder have that capability. The other thing is that it's critically important that you generate revenue, and it's critically important that you really validate whatever you have. So customer discovery, going out and making sure that that product or service, the people want to buy it, right? That it's not something you overdevelop. But many times technology founders will go out and they'll develop something that's incredible. They spend a lot of time and a lot of money, but nobody wants to buy it. So I've been through that. We've had to pivot Eva 3 times and pivot it because we had a phenomenal product. Google liked search for the personal cloud, but people loved it, but they didn't want to pay money because they're used to getting things for free from Google. So you've got to get down through and just validate it before you spend a lot of time and money. And what does that mean? That means you get out of the door, as Bob Dorff and Steve Blank say, and meet with potential customers, get their opinion, and do that before you spend a lot of time and trouble, fully vetting the product. So I've done it with PowerPoint presentations, and I've taken my iPhone on a stand in Palo Alto, California, walk down the street, going into coffee houses, and ask people for 5 minutes of their time to get feedback. So those are the kind of things. So when you're building a unicorn, it's never easy. Let me just tell you, it is not easy. It's easier sometimes, but the difference between success and failure is about this much, right? So it's having that persistence and tenacity to get over the top, and staying positive.
Yeah.
Staying positive is critically important. So one of the things especially with startups in Eastern Europe, it's oh, I don't know, maybe, I'm not going to invest in a company if somebody's saying maybe, or
Maybe.
I don't know, because if you say, or I hope, because if you say those things to me, that means that my money may get lost, and I do
Totally.
not like losing my money.
Absolutely.
So make sure that it's not only you have that. I did a TED talk, a TEDx on that particular topic. So I would go down through, you want to stay positive, visualize where you want to be, and come up with a realistic plan based on the financials, right? This is, make sure your financial model works. Make sure when you're raising money that you can justify the spend, and try to keep it lean. Even when I raised over $7 million, I had I rented a co-working office for a couple $100 a month. I kept the expenses way down till you figure out what you have. So it's, and then the other thing is there's really three levels of startup. 1.0 is acceleration, 2.0 is regional dominance, 3.0 is going global. Each one of them represent hurdles. And the key is overcoming. One is you get MVP, product market fit, first customer, startup 1.0. Startup 2.0, regional dominance, whether you're in Singapore, Australia, Africa, Europe, US, whatever, you dominate that market. But then the key is the magic and the enchantment is going global. How do I take it to another market? How good am I as a founder to take it to that market? And by the way, after 150 people, most of the time, CEOs, the original CEOs, don't survive, right? So they find other CEOs to come in because each level of a company, there are different skill sets that are needed. I don't like to have meetings for meetings. So for me, through a Series A or Series B is really interesting, but past that, it's not interesting because, oh, let's have a meeting to talk about a meeting because we want a meeting. And it's not, so each level of a company has a different kind of a requirement. So, and you have to be able to have founders that are flexible. So building the unicorns, you've got to have some flexibility in the model so that you understand that you may not be the person at the end game. Most of the time you won't be.
Right.
So there are rare exceptions like Zuckerberg and Facebook and Steve Jobs and those kind of folks, but generally not.
Great opening remarks, Gary, giving a very holistic picture about how to work towards becoming a unicorn. Thank you so much. We are joined by Sergey. Hi, Sergey. Welcome to VCTV.
Hi. Thank you. Yeah, I had some small troubles with the connection, but should be fine. Happy to see you again, and happy to see you, Gary. Happy New Year to you too.
So, where are you dialing in from, Sergey, today?
Right now, I'm dialing in from Moscow because COVID and all that. With all tests passed and everything, I was happy to see my parents because I haven't seen them for a very long time, and to spend some time with them. Yeah,
that's a good thing to do. And welcome back on VCTV. It's been a while that I had you on my panel, my episode of VCTV, and I'm really excited to hear some of the great insights coming from you on this topic about startup education, how to build the next unicorn. Let's start with some opening remarks from you, Sergey, regarding this topic.
Well, first things first, but unicorn is kind of a thing that mesmerizes mind of most startup founders. But I think what they should begin with is do they really have an idea that could kind of change the world, or they just in this game for being a unicorn? Because it's not just a cash pursuit to get the hugest valuation and all that, because there is a myth. There is one big exit is every founder's dream. But the thing is that many successful founders actually care less about getting rich, but care more about making a game-changing product leave their mark, script history, revolutionize the industry, disrupt the outdated pipelines. For example, Gary has noted that, and I'm sure he also he also met such founders that just think about these, valuations and, figures and numbers, and not care about getting the right product done. So if we think about building a unicorn, probably don't have this final goal in your mind, because what you really need is building a product that market is happy about and investors are happy about. And then you will eventually come to this unicorn stage. But I don't think you can build something really worthwhile when you're already dreaming of this, like, should be the biggest thing. I mean, it happens, but sometimes you can end up with something like Tyrannus, the notoriously infamous startup that had this, blood testing and diagnosing the diseases hustle, actually. So they had in mind this being a unicorn, having a unicorn status. It's all about the money. As for another steps, I think what you should pay for, Gary said it correctly, that you should have a very competent team. There is a myth that there should be 2 founders. It's quite popular, but if we look at the valuations at the next stages, you not necessarily need to have 2 founders. You can be perfectly, if you're 1 founder. The thing is that you should cover main strategic angles of the project, and you should be able to do it yourself, not outsource them. You should have a very clear vision of what exactly the project is. And when, for example, I see pitches and presentations, sometimes the founders cannot answer the simple question in 1 line, what this project is about.
Yeah.
Because when they start saying very complex things, you can clearly see that they are kind of lost in their mind and they cannot figure out what it is about. For example, again, it's exactly right. You should be able to present this project to very, multiple people. Just talk to them and say, what do you think? Like, I have this project and here's a short explanation. What do you think about it? And if people start saying, I'm not sure, I've seen companies that have to, then when you see their logos, when you see their presentation, you come to them and say to them, oh, you do this thing. And they say, no, we're actually another. And the problem is, it's the perception. It's how your investors will see you and how your markets will see you. And another thing that I want to emphasize is actually, I'd say always do your proper accounting, always do your proper groundwork for that, because if you got messed up with your cap table, if you're too excited to go into the startup world and you already gave up 30% of your equity, or
yes,
your funds are messed up with your private funds, then most probably many investors will just turn you down because their financial management said so. They may be very excited about your startup, but if already at the very beginning 30% of your equity being given up, they will say, I'll pass. If already in the accounting side, there is every budget is messed up, then probably it will be a no-go. And investors have their own financial advisors. If they say no, we're not recommended, they will probably look for another option. That's probably what I would.
Yes, okay, I've got a question, because I've known a founder who was ready to give away 50% of equity at the beginning. But what is the psychology? How are the investors thinking if they're giving away equity in the beginning? Like, why would they give it a pass, like not entertain them? What's the reason? What's the psychology behind that?
You mean the psychology behind the investor's mind to get
investors?
Well, I can't say for these investors because I don't think it's wise. I don't think they really understand. Well, you could give up 50% of equity if it's not a startup that you go into put through next funding stages. If it's just a business that's supposed to bring profits and not expected to receive any investments in the future, then you
Right.
can definitely get the 50 or even 60% of this business. You just invest and ready for profits. But no
Right.
one will buy this at the next stage. So if it's a business that has in mind next funding rounds and growth, then you shouldn't give away this much equity.
All right. Thank you, Sergey. Shrikant will be dropping off soon. So I've got a question because Shrikant is also a lawyer. What is the importance of M&A when you are sort of structuring a startup? Because you must have been involved in a lot of M&A.
Yeah. Well,
Shrikant, over to Shrikant.
yeah. Sorry.
I would love to hear you, Sergey, but let me just give quick thoughts on this and then let you continue. I believe M&A as an option is either considered too soon or too late. So I think there cannot be a definite answer as to what or when can a acquisition happen. A lot of founders, I think they have unfounded belief that they would start up this particular startup with the idea of selling it off to a larger startup or a larger company for $1 billion valuation. So that is I would say apparent mistake that startups seem to be doing. But what seems to be happening well is also the fact that startups are delaying acquisition opportunities with the hopes of getting private equity players. So I believe that these are two ends of the spectrum, and if they have to be seeing eye to eye, like Sergey mentioned, you should have a good financial advisor beside you, telling you exactly where, what perspective would an investor kind of bring in if she or he sees your startup. So I believe that is what is missing. Putting yourself in investor's shoes is what is missing from the startup perspective.
Okay, believing quickly, another question. What are some of the Indian unicorn startups? Are these startups always born out of, these unicorns are always born out of Silicon Valley, mostly because of Facebook, plenty of them. What about some of the Indian unicorn startups, and what did they do differently to come to that stage? Just quickly before you jump off.
I believe India has a lot of potential. I believe it's a myth that the Silicon Valley actually produces a lot of startups, or $1 billion startups or unicorn startups. India has produced and consistently has marquee examples of startups which have been unicorn born and bred in India. So it's quite a myth. I think what they get right is also a bit of luck and a bit of, I would say, the internal management that they have done properly right from the beginning. I believe good startups or stellar startups would be ones which put themselves in the shoes of an investor and think about what would an investor think before they invest or before they go out and launch a particular startup as such. So I would think a good management or a good team is the key for a startup to be successful and to actually aim for $1 billion. So I believe any startup which aims to become $1 billion startup in 2 years would not be realistic as such. So I believe one of the things that is happening in India is also a lot of companies are looking for IPO. It needs to be a well thought out strategy. So my advice to startups would be to pause, think, rethink, and then approach an investor. See whether you can manage from your internal funds and so on and so forth.
All right. Thank you. Great points, Shrikant. And lovely to have you on BCTV as always. Thank you.
Can I add shorts about M&A? Short words.
Of course, margin and acquisition. Yes, please.
Just because I recently wrote an article about busting the 5 myths surrounding the startups exits. So one of the myths is that M&A is something you can quickly do.
Right.
So because there is a myth that founders, if they have difficulties raising the next round, they can simply, be bought and acquired by a strategic partner, bank, telecom giant, whatever. And the thing is, first, this requires years of preparation before executing. It's a very lengthy and exhausting process. So it should be embedded in the company strategy early on. It's not something you can pivot to within 6 months. Another thing is M&A is usually more exciting for investors than for founders. Because for VCs, it means that it's going to be high evaluation due to takeover premium, 100% liquidity upfront, no obligations to do follow-on investments. So for investors, it's fine, it's great. But for founders, usually, it's less exciting because they're usually becoming employees of another company. It means they're becoming a part of something bigger, which may not be good for everyone.
Yep, sure. Thanks for adding those points. Very valuable for those startups who are watching us today. So that's why that's the very importance of this panel today. I'm going to pass the word to my co-moderator Amit now to moderate the session. Over to you, Amit.
Thank you, Sony. Every point spoken is a bullet point that has to be noted here. So my basic question is, for a founder who is just starting out with their MVP, how important is it to find a co-founder, and how to find a co-founder, and what are some characteristics from a VC point of view? Let's start from Gary.
Gary, you there?
Yeah, I'm here. Sorry about that. I had to grab something. Yeah, no, I mean, the situation in terms of a co-founder, from my standpoint, I always look for co-founders that are technical and have a background. With Eva, David Yang, who's the founder of Abby, one of the top AI companies in Eastern Europe, a billionaire, is my founder in that company. And the reason is you want somebody that has skill sets that you don't have, right? That can really complement you and actually give you other viewpoints. So you don't want to have any more than 3 co-founders because it's really hard to get funded. If you have 3, it's okay. If you go to 4, it starts to get difficult. So the unwritten rule is they don't want to fund startups over 3 co-founders. And in terms of, you're just looking for people who have complementary skills. So if you're a marketing, sales, business development, operations person, you want somebody that's got technical skills. Or if you don't have those skills, you may want to have somebody that's more operationally oriented. And you want people all the time that have that positive energy and optimism, because when you're going through this and you have the down cycle, you need somebody that can cheer you up, because there's ups, there's downs, there's ins and outs. I mean, look at Click Software. So the company came over from Haifa, Israel. The market turned sideways. There was a huge crisis. The internet bubble burst. People said we were going to go out, right? We did an IPO on NASDAQ during dark times. March, the market went sideways. June, we did an IPO on NASDAQ. 20 months ago, sold to Salesforce for $1.35 billion. It wasn't easy, believe me.
Yeah.
You go through it. But
Right.
if you have that attitude and you have the right kind of skill sets in there, you can pull it off. So that's part of it. And I say, the soft side of doing a startup is, from my standpoint, is really the most critical, because you got to have the heart of a lion in order to get through the thing. And the good news is you can do it. The bad news is a lot of people give up, right? They don't, because it's like pivoting. People talk about pivoting. Many people give up. But the thing is, I look at it as like you're going down the road and you make a U-turn. That doesn't mean you failed. You just made another choice. You made you took a different direction. So that's where we are with it. So it's, and in terms of companies from around the world, one of the things we said, think about this. So if you're going to go fishing, you want to go fishing in the pond or a lake where there's fish. So the reason I use Silicon Valley as a port, and that's where our office is, and that's where I generally live, is because if I want to raise money from China, Israel, and I have Europe, Russia, all over, Ukraine, Belarus, Africa, I get the money there. It's just easier because a lot of the folks have offices, innovation offices. Of course, with COVID, there are some amazing challenges that are out there. You can't go out to lunch or dinner with people, or breakfast with people on El Camino Real right now because of the crisis, because of COVID. But listen, that's going to change. And so there is a democratization opportunity. Things are being spread out. But remember, you have Stanford University in the heart of Silicon Valley. So a lot of it is surrounded around Stanford. So there's a great opportunity out there. But we use Silicon Valley as a port
Absolutely.
for the rest of the world.
Thank you, Gary. Harsh, with the same question from Amit.
So definitely the point which Gary pointed out, right? You have a co-founder with the balanced skill set, right? So me being from the growth and the marketing background, I would look at someone from the tech background and who would kind of help me build the tech. But it's not just about the skill set. I would also like to add another point. It also needs to be a mindset complementarity, right? So me, I am a slightly more being a seasoned sales professional, I tend to be very calculating in terms of what the sales are going to be like and very realistic, right? However, to build a unicorn, you cannot be that practical always. You need to have slightly more ambitious and more visionary goals, the ability to think from 30,000 feet. So that's why you need a fellow co-founder as well, who can look at it, who can really imagine something new, who can, who has the long-term vision and of something grandiose to be able to work towards something like that. And at the same time, have someone like me who has a balancing effect, who also has some sort of, dare I may say, some sort of fear as well. And I believe fear is good because that kind of keeps you on your toes to kind of ensure what the other competitors are doing, to understand what the other investors are thinking about, to be able to sit, in the other person's shoes and think through what they are doing. So a healthy amount of fear with a healthy amount of optimism balanced between two individuals. It's next to impossible for a single individual to have all these mental skills at the same time as well. So that is where I look at it. So that's why having importance of a co-founder, not just from the skill set point of view, but also from the mindset point of view, is extremely important. And even to find someone like that with the implicit amount of trust, that is the most difficult thing which I even found out. So during my first startup, I was starting out by myself, and the journey was extremely tough. And eventually, I had to quit because I lacked a fellow co-founder whom I could trust enough for the same, right? So that is extremely important, to find someone that you can trust. And even though you'll have a lot of arguments, you'll have a lot of fights, but inherently you must, that trust is extremely important, to know that you're both working towards solidarily towards the company. That is extremely important.
Amit, can I say one thing? So I was fortunate to have a lunch slash dinner with with Rupert Murdoch's right hand man. So Murdoch, for Fox, right? And I had it with the brother of the founder of Google, who is some of the original money in Google. So Carl Page. And I was invited. An actor friend of mine came with me. We're invited to this incredible dinner in the same building where Mark Zuckerberg started Facebook. By the way, actually, the second place he had Facebook. First was in a house. Anyhow, I had a chance to have dinner, early dinner with them, and it was fascinating because when we had these imagine, original money in Google, right? So you can imagine his brother, Carl Page. So anyhow, Straczynski was there. Straczynski bought the Wall Street Journal for $4 billion, and we were talking about that at dinner. And he said, I've analyzed 3,000 entrepreneurs around the world, and I had a couple of wines, and I would just, I was really curious, like I always am. And I said to him, what did you find? What is the number one thing that you found with the most successful entrepreneurs in the world? And he said, there is one thing. He said, amnesia. And I said, what are you talking about? He said, they never talk about the past. They only talk about the present and the future. Never.
Wow.
And every one of the billionaires that I've worked with, and I've worked with a few of them, and I'm partnered with a few, they're the same. They never, ever talk about the past, like in a negative sense. For context, sometimes yes, but never let the past hold you back.
That's a very good learning point, not only for, I think, founders, everybody in life. Thank you so much,
Well,
Gary.
that's it. I mean, because you have these emotional anchors that are out there and you never go forward. How many times do you know somebody that says, oh, but this happened to me before and I don't want to do this? It's like for my situation, get back up. Hey, listen, the thing about life is you get back up and look at the beauty, the enchantment of life. all the things around you. But if you start looking at the negative stuff, you know, some people, the older they get, what happens is they start to build a cocoon around themselves. And so they don't want to have any kind of, you know, excitement, and they don't want to explore, and they don't want to try things. My thing is, I mean, for me personally, I mean, it's like, if there's something cool, I was going to parasail the other day, and I haven't parasailed for years, just because I thought, I was with she said, "You're crazy." I said, let's go sail. So you got to try things. Always, the founder of, I don't know if you remember Sun Microsystem, but
Yes,
Scott
of course.
McNeely. So I had lunch with him in California. And so Scott and I mean, we had an incredible conversation. But one of his things he said, and I'll never forget it, and I told him this, is that you've got to go to areas that you fear the most, because there you're going to learn the most. And
Absolutely.
we tend to move away from areas that we fear, not to go towards them. So this part of life, the, you know, the Pygmalion effect, the self-fulfilling prophecy, if you believe you can do things, you can. That's part of being a startup too, is those simple rules, amnesia, right? Go to areas that you fear, you're going to learn the most. I have, right? Sometimes I got to force myself, but let me tell you, every time you do it, it's like sharpening a knife. You get better and better and better.
Absolutely. So we have Amit in making. So he's now on VCTV. He's facing his fears. Amit, over to you. He's now so, like, you know, confident coming on VCTV. He's going to be hosting show on his own from next week. Amit, over to you. Just put you on the spot.
Yes, Sony, right words. So I'll move back to the next question. So basically, this COVID has sparked a lot of revolutionary technologies like blockchain, AI coming into full force. So basically, as a first mover advantage, you're always ahead at the competition. But as a last mover's advantage, you always escape the competition. So when should startups follow each of these strategies? So I would like to start from Sergey first.
Okay. So if I got your question right, you're mostly asking about whether or not these technologies one of them going to be the next unicorn. Is that correct?
Can you repeat your question, Amit, again?
Okay. So basically, I was asking, like, as a first mover advantage, you're always ahead at the competition. If you move first with the technology, you're always ahead of the competition. But as a last mover, if you move at the last, you will escape the competition. So when should startups follow each of these strategy? When should a startup follow a first mover advantage, and when should a startup follow a last mover advantage from an investor point of view?
Well, from the investor's point of view, all investors hate risks, right? So that's not a surprise. So for them, being a first movers is always very risky strategy. There are some investors that, of course, embrace they enjoy risks, but still they want returns. So being the last mover is not the right strategy for a startup, I'd say, because the last movers are usually corporates that implement this strategy into their own strategy, right? So the last embracers of the technology usually the most conservative, the most old ways of doing business companies. So if a startup wants to succeed, there are some areas where it could be only one. We can think, for example, of Airbnb. How many other rentals does the world needs? We can think of social networks. How many social networks does the world need? But there were successes, regional successes. But some of them were built mostly to be acquired later. But we can think of, I'd say, better to be, if you're brave enough. For a startup founder, they always trying to be first, but from my experience, being the very first is usually paving the way for the others. So if we think about some technologies, for example, touchscreen, it wasn't Apple who invented this touchscreen. There were phones even before 2000, 2008, there were like Philips phones. They would have some touchscreen technologies. It was Apple who wrapped it up correctly. So it was not like pioneering from them. If we think, for example, car sharing, nice technology, but it's a nice concept and technology. But what I've seen, I mean, the companies that started this, they paved the way, and then they kind of faded out, and then the more stronger companies emerged. So from investors' point of view, they like to look at the market. If it's just a pure invention, they're very sensitive from what market this invention can come from, because it's, as a rule of thumb, they are more excited to see the inventions and pioneering technologies coming from, let's say, from Silicon Valley than let's say from Singapore, simply because they want. It's not that Singaporean technologies are not great, they are, but they kind of expect them to be built upon what's already working in Silicon Valley, what's already working in big developed markets, because Singapore is a small market, and you kind of need to start thinking of regional expansion right away. And where are you going to expand to? Malaysia, Indonesia, Thailand. There are not like first tier markets where every investor wants to go to. So everywhere we can see that there are pioneers. For example, Facebook was built upon Classmates. If there was a social network called Classmates. There was a social network, MySpace. Who remembers that? So I'd say that going the very first wave is worth it, but could be very risky. And if we speak about investors' point of view, like I said, investors are not very happy about it.
Okay, so if I understand, so investors are little not into those startups who are like first mover in the industry. Am I correct?
The startups that are first movers in the industry, they need to have way stronger MVP. They need to have a very aggressive development strategy. How they're gonna conquer the market, because they cannot evolve slowly, because there are companies that are just waiting to see how you test this technology, and then they're ready to grab it from you. So
yeah, correct. As an analogy, do you think MSN, when Microsoft started their email, MSN, and then Yahoo, then we have Gmail. So Google itself has been the dominant player in the space, like Google search, and they were the last to be in the space, I guess.
Yeah, and they were very flexible. They were very fast. At this stage, when Google launched Gmail, it was very, agile company, was so to say. So Microsoft and Yahoo were very, very, conservative companies. So it was not a surprise that they, take over.
Yeah, great. Thank you so much, Sergey. Amit, sorry, I had to get this answer.
Okay, no issues, Sony. So yeah, let's hear it from Harsh now. What kind of strategies do each startup should follow?
So either it can go for the first mover advantage, has its own advantages and risks, as well as probably coming down the line. I would not say last mover advantage. What I would say is probably like once the first mover advantage comes in, a few startups can kind of see what the first mover is doing. Based on the learnings from that, they can then kind of improvise. So I think even Sergey was alluding to the same fact. So once the first mover advantage comes in, there are some learnings which have been developed from the first mover advantage, right? And after a year, probably a year or two down the line, the companies which can come after that and kind of improvise on the learnings which have been made, they are very ripe for investor attraction. That's yes, the market is already, by that time the market has already been proven, and now they are also learning from the mistakes which have been done by the first mover. So that is why it becomes extremely easier for them to raise funds. At the same time, on the flip side, if the first mover is surprisingly doing so well that it doesn't even give the opportunity to the second mover, to the people who are coming down the line, then they can completely demolish them. So if you look at someone like Amazon, etc., that the fact that they were the first mover and they were doing it so well, It did not leave too much opportunity for others to kind of come in. However, that's a rare exception. More or less, what we've observed is first movers tend to find it very hard to kind of even prove the concept in the market, and even to survive, to get that proof of concept stage. Even right now, if some startup comes to me to raise funds, I would say you need to prove the concept to me first. Unless that proof of concept is there, to be very hesitant to kind of put my money in that. But if you have companies like Amazon and PayPal, they are more like the exception rather than the rule. So I would suggest the strategy would be, the first company kind of moves in, kind of tests the waters out first, kind of proves that there's a potential market, and then these kind of companies come in. That would be the ideal scenario for the startup as well, to kind of say that yes, this is the best opportune time to get into the space right now.
So yes, greatly put, Harsh. Gary, do you want to add some points here?
I can add lots of points. So what, I mean, what do you want? What exact question do you want me to answer?
So to summarize, I would like to ask you that what should a first mover, what should a first mover?
Yeah. So, I mean, look at, so when you look at it, when you look at the search engines, Jughead, Veronica, Primitive Web, InfoSeek, Yahoo, Web Crawler, Lycos, Excite. I mean, there were a lot of companies before Google, right? So they did not have the first mover advantage. So they were, in 1996, there were only 257,000 websites on the web. So look at where we're. So a lot of times it's the first mover advantage is not really an advantage. As Sergey had said, think about, where we were with MySpace. MySpace was first in, but look at Facebook dominated it. Well, here's the other thing is you spend a lot of money educating the market because they don't know what it is. And that money spent on the first mover side, the second mover does not have to go down through and really throw that much money. They can really focus on how to build the best product. So you got to be a little bit cautious about it. My thing is, just this is Gary's rules. I mean, it's get shit done, get out there. And I don't care if you're first, second, third, or fourth. If you don't try selling something, you got zero. You know what I mean? It's like, it's either you try selling that's the other thing. I mean, a lot of times people spend so much time talking about what they're going to do, they never do it. And so there's a reason 9 out of 10 startups fail. And that's one of the big reasons. They just talk. So customer discovery, go out and see if people want to buy your product or service and grab it out of your hands, as Bob Dorff said. So there's a book called The Owner's Startup Manual. It is the best book in terms of the formula to be able to increase the probability of having a successful company. Use the book, right? Validate your hypothesis. A lot of times technical founders build some incredible stuff that nobody wants. And the market doesn't want to pay that kind of money, and they spend so much on it, it just becomes a problem. Make sure to test it. You don't know. I mean, I've gone down through personally, and you got to test what's the market going to bear. You'd be surprised sometimes. I mean, sometimes with one of my companies, we charge $5 a month for something, and it's really a $25, $30 a month. It's worth $25 or $30 a month to the customers, right? So you got to be careful you're not underselling yourself too. So there's something to be said for that. So test the market, make sure that test the pricing models. What would you want to pay? How much would you pay for this? Would you pay 10? Ask them. And so when you go out, what I do is I look at a minimum of 100 people that I want to talk to, 100 decision makers that can give me the feedback to be able to refine what my pitch is going to be, refine my product offering before. And by the way, I actually, fake it till you make it. I've done presentations at VentureBeat on stage in San Francisco using just slides of something that wasn't developed yet, because I wanted to see how the market will respond. And so, put it out. We didn't have AI in EVA. When we first got started, there was no AI. And I said, we need to have it. So because I knew 4.5 years ago it was going to be really hot. And so we hired a part-time machine learning. I hired a part-time machine learning developer to develop some AI to put in it. Guess what? Look where we are today. Everybody's talking about AI. But when I did it, I caught a predictive insights, right? With artificial intelligence. I made it up in 3 weeks. We put mock slides together, et cetera. And then I had 317 articles written about the company after that presentation. So you got to try it, put your ideas down in a PowerPoint presentation, put some mock-ups and see what happens with the market.
Great. So to summarize all the points said by Sergey, Harsh, and Gary, basically it is like you should never opt in for last mover advantage. That's what big corporates do. They sort of look at the whole market and they're conservative about their plans and strategies, and say they move at the last. So the first mover advantage generally are very excited and they jump into the market, but you should be very flexible in order to survive in the market and actually succeed it. That is the whole summary of this question. Over to you, Sony.
Thank you, Amit. Nicely summarized. Thank you so much for that. And Gary, as always, very great insights. I've got a question. Do all the startups need to be working towards becoming a unicorn? Sergey, I'd like to start with you.
Okay, thank you for the question. Well, I think no, because what many founders forget is that being a unicorn is also a burden. I mean, it means that you have at least $1 billion valuation. There are huge amount of money already poured in, and usually at this stage, founders don't have that amount of influence over their own company. It's the investors that kind of dictate how the company, what the company will be in the future. So you should understand that with this amount of valuations, you're not the one sailing the ship. And sometimes you're not even at the helm. For example, I've just recently commented on the Southeast Asian news about the potential merger between Grab, the taxi riding app, as we know, the actually unicorn and behemoth with over $1 billion in valuation, and the Tokopedia. And before that, they discussed about Grab, not Grab and Tokopedia, about Gojek and Tokopedia, and before that, discussed about potential Gojek and Grab merger. So the thing is that these companies have nowhere to grow to. They're at their Series F of the funding. There is already so much money poured in, so they cannot go for a next round of funding. So their only exit, investors are hungry for exit. Their only exit is through potential IPOs. So basically, they want to merge with some other company and making this IPO more attractive. But the fact that the SoftBank stands behind all of these companies, it's kind of SoftBank that dictates being a major stakeholder, not a shareholder, because the shareholder, for example, Uber holds some part of a Grab, but Uber is owned by SoftBank, so you kind of see how these all goes to real stakeholders. And the thing is that it's the stakeholders at this stage that kind of say, you should do that. You should consider merging with this company. So being a unicorn might be very exciting as it sounds, but you should be ready for the pressure. Yeah, you'd be making the news, but you need to understand if that wasn't your intention, because not every founder actually wants to be a millionaire. That's the thing. Not every founder wants to be a millionaire. Some of them just want to make a great product and see how people are happy about it. So if this is not your path for bigger money, sometimes you need to say no for next investment round, because it's your interest as well. Sometimes your interests are not always aligned with investors' interests. That's right.
Great points. Not every startup founder wants to be a billionaire.
No.
Great points. Thank you, Sergey. Harsh, over to you with the same question.
Yeah, I definitely agree with a lot of what Sergey said, right? A clear example being Flipkart. By the end, the Bansals
Mm.
were no longer in control, and it was Krishnamurthy who was, kind of running the company. He was the CEO, and he was the front running the operations of the entire company. And that is just one of the examples. I'm not sure if you're familiar. Recently in Oyo, there was a huge conflict within the company and the investors, and they were try. He actively kind of bought back the shares from the investors just to give them an exit and kind of take back the equity and take back the control of the company, right? So that's why that the unicorn dream, I see startups day in and day out having that unicorn dream, but they don't kind of realize the kind of the stresses that is involved. And most important thing which I look at it is they essentially the vision of the startup, the vision of the company is lost in the process, right? The startup was originally launched for a specific purpose, for a specific vision to make life simple, but by the end the priorities of the company shift. It is then and not just the company, even the foundership. Now, instead of creating value for the companies and the employees and the customers, the focus is more shifted towards giving the investors an exit, right? That itself is a huge detriment to the startup's long-term survivability. So that is why I personally believe that the focus should be more towards creating long-term sustainable value instead of just following, just looking at starry-eyed towards unicorns per se.
Yeah, thank you, Harsh. Really agree. Sustainability is the key need of power. Thank you, Harsh. Gary, over to
Absolutely.
you.
Yeah, I mean, the situation from my perspective. So we do search for unicorns everywhere with this democratization of opportunity, whether in Africa, whether in Asia, the US, doesn't matter. We have companies all over the world, but we really look for groundbreaking, exciting technology, in particular artificial intelligence and quantum computing, because those are really hot. I mean, think about it, like all the data around us. So I've talked about this many times. Think about all the data around us, 40 zettabytes of data, which is enough to go to the moon 29 times if you stack CDs one on top of another, and grown at 62% per year. So we got to have these incredible tools. And by the way, these become unicorn opportunities. They're not lifestyle businesses because you're dealing with immense amount of data. Think about what happened recently with drug discovery. I was on the call with eight AI. Oh, I don't know why they asked me to come on the call, but I did. As 8 AI experts, quote unquote. I felt like I shouldn't be there, but I was. Anyhow, was working with the top pharmaceutical companies in Europe about the next generation of drug discovery. And the COVID vaccine was developed, Pfizer, using IBM Watson. So not having bench time. So we are inundated. We're in a state of infobesity as humans. We need to have technologies that can help us make sense of it. Look at what's happening. I mean, Google, the reason Google's really successful, they got a lot of artificial intelligence, some of the best engineers in the world. Zoom. 5 years ago, when I got the chance to be one of the early users, it was because of the artificial intelligence. Emergence is one of their VCs. And so it is a way to be able to make our world better and to be able to help us. So those have the potential to be unicorns. And remember the other part, just FYI, that the models of artificial intelligence can be used in multiple vertical markets. The difference is the training sets. So, and I've written a couple of articles about the transportable AI model. So this is incredible opportunity. And so me personally, I am looking for the unicorns. We've been fortunate to build 2 unicorns, been involved in that process. And so that's really where we are. It's hard to get funded if the VCs in Silicon Valley don't feel that you have a capability to become a unicorn. And you got the team, you've got an incredible technology, and the market is ready for you. So if you don't really have those, it's hard to get investment, the right kind of investment, tens of millions of dollars to be able to really get your company rocketed. And the other thing is these companies need to figure out, just FYI, it's not a bad thing to take money if you want to really maintain an advantage within your market. If you think that having that money is going to help you. I have one company right now, it's a remote patient monitoring AI company out of Stanford. And that particular company having money in just helps them grow like 10x, right? So what is the purpose of the money? But yeah, I mean, I'm looking for unicorns that really have incredible capability. Do you want me to start with closing remarks, Sonny? Do you want me to, since I'm already speaking? So
Sure, Gary, go for it.
yeah, this is a great opportunity. I just wrote an article that's going to be coming out of Medium about AI and when we finally pass the processing power of the human brain and the implications. If we get a chance to I'll probably have it out tomorrow. But this is an amazing opportunity for each and every one of the startups that are on this call, each and every one of investors that are looking at technologies that can put a dent in the universe. It's a great time. You can reach me. I am the CEO, president, co-founder of Get Shit Done, GSD Venture Studios. You can reach me on LinkedIn. You can get me on Twitter. You can send me an email, gary@gsdvs.com. I'd love to hear from you. We're looking for incredible companies. We curate them and use Silicon Valley as a port to the rest of the world. So great to be here, Sonny. And we love VCTV. You've done an incredible job. The entire VCTV team has done an incredible job during these dark times of shining some light on each and every one of the people that have been able to participate. So thank you.
Thank you, Gary, for those lovely, kind words. Next, I have Sergey.
Yep. Thank you. Well, first of all, yes, again, thank you for inviting me to VCTV. It's a great opportunity, and I love these, these talks that we have, because they're really, they're both professional and kind of private. So I feel it's like a bit of a coffee club, and that's very nice. So it's for the startup founders. I'd really again say that do not pursue that unicorn goal just in mind. Do this because you want to do this, not because you don't want to do anything else. Do this because you kind of have a passion for it. Because I've seen some people that turn to entrepreneurship simply because they failed in other things, and they say, oh, why not I try this? You kind of need to want to do this, not because of the frustration, but because of the determination. It's a different motivation. So yeah, well, again, happy to see everyone, and thank you, happy to be here.
Perfect closing remarks coming from Sergey as well. A point to be noted for entrepreneurs. I mean, don't move to entrepreneurship. It's not easy to be here in this space, and just don't move to this space if you're not ready. Don't look back and amnesia.
And yeah, have amnesia.
Yeah. So that's a life lesson for everyone. Thank you so much, Sergey. And obviously, I'm going to have you back on another panel soon. Harsh, over to you, the closing remarks, please. Harsh, you unmute and.
My bad. So definitely, I would like to urge a lot of founders to kind of, as Sergey pointed out, focus towards your passion. If the focus as an entrepreneur should be to make a dent, to make a difference in the world, and something which gives you satisfaction, right? Something that at the most dear thing in someone's life is, at the end of the day, you need to have satisfaction that you've done something valuable, right? Not everyone is built for kind of building a unicorn, and it's just been glamorized too much in the media. Try to stay away from that noise and try to focus on adding more value towards your company and towards your life. Recently, there used to be a trend that if people are jobless, they become entrepreneurs, right? So we need to kind of break that cliche.
Yeah, that mindset.
That we don't need to get caught up in that cliche. Yeah, and kind of do get into this only when you have the serious feeling inside that, yes, I want to make a serial difference in life of people and to make a serious impact. Just targeting a unicorn status, it's like an empty it's like an empty goal. You'll just keep running towards it, and once you reach it, there'll be nothing there. It's not as gratifying as it sounds. So that would be my final remarks. And to end that note, I would like to thank VCTV and Sony for organizing these amazing sessions. I'm getting the opportunity to interact with brilliant people like Gary, Sergey, and everyone to learn from what people across the world are thinking. Couldn't have asked for anything more.
Thank you so much, Harsh, for joining people's representative from our Ventures. And thank you so much for your participation as well. Really appreciate it. And thank you, Sergey. Thank you, Gary.
Thank you.
Thank you, Amit. So we come to the end of the show. Startups and entrepreneurs, we are actively seeking more founders to be on VCTV. We have the investors, and we've been repeatedly hearing that they need to see more startups on VCTV. So this is the opportunity for you to come and pitch your ideas, your product on VCTV. Again, investors, you can always share the space, as Harsh mentioned. You can always share the space with other investors, get the experience, gather the exposure, and get benefited by VCT. Thank you so much. And I'll be back again tomorrow on another topic, another set of speakers. Till then, keep watching VCTV and have a good day.